Hi, so in this video we're going to be discussing liabilities. So this will be very similar to the previous video which was on assets, but instead of assets of course we are looking at liabilities. So what are they? Well, these are the items which a business owes to a third party. So while assets were something that we own, for a liability it's something that we owe. So what we might think of as being the opposite. A liability is something that we are liable for, hence the name, and it's something that we're going to have to pay off in the future, something that we owe. We can think of this as debt that a business has, but okay, that's what a liability is. And very similarly to what we did with assets, when we are looking at a company's accounts, these liabilities are going to be split into two different types. And these two types are non-current liabilities and current liabilities. So we'll just quickly go into those two types so we understand what we mean when we're looking at a company's accounts or a business's accounts even, and hopefully we can add a couple of examples and this will all start to make a little bit more sense. So our first type is non-current liabilities, and these are the long-term liabilities. And when we think about long-term, we are thinking of liabilities which are payable over 12 months from the date of the statement of financial position. So we, in a previous video, looked at what a statement of financial position was, so I won't go over that again. Check out that video if you haven't. But when we have a statement of financial position, this is going to be a snapshot of a firm's position, and so it's going to be dated, and this is the date that this statement of financial position is released. So we might see a common one as being maybe the 31st of December is when a statement of financial position is released, and let's just use the example of 2020. So a long-term liability is a debt or something that the business owes to a third party that will have to be paid off over 12 months from this date. So for example, a loan that has to be paid off in 2022, obviously this has to be paid off more or over 12 months from the date of the statement of financial position, so it will become a non-current liability because we classify this as being a long-term loan. It has to be paid off more than 12 months in the future. So this is why in this example section we have got long-term loans. This is probably going to be the most common form of non-current liabilities that you see in a company's accounts. So we can think of things like a mortgage that has to be paid off a long time in the future. If we're just thinking of an obvious example that lots of people have, just any sort of loan that is going to be paid off at a much later date. And then obviously the flip side of this is going to be the current liabilities, and this is just going to be everything else that isn't a non-current liability. So of course this means it's going to be our liabilities which must be paid within 12 months of the date of the statement of financial position. So using our example of the 31st of December 2020, this will be, say, again, it could be a short-term loan that has to be paid off in, say, April 2021. So this would be within 4 months of the date of our statement of financial position, so we view it as a current liability because it's a short-term loan. And if we're thinking of obvious examples or common examples, we think of these payday loans where we see adverts for all the time, where they're very short-term loans. You could also think of your bank overdraft. That is seen as a current liability. I mean, for your bank overdraft, you may pay it back a long time in the future, but actually a bank can ask for that money back at any time that they want to, so it could technically have to be repaid within a day, although banks don't tend to do that, fortunately. But we think of it as a current liability because it might need to be paid back within 12 months. So another example of this, as I've got listed here, would be money that is owed to suppliers. So if a business uses a certain supply, for example, if it's a furniture manufacturer and they use lots of wood in their manufacturing, they're going to have to tend to pay their suppliers quite quickly. Suppliers aren't going to really be happy if you're paying them off more than a year from when they've supplied you. So money owed to your suppliers is going to tend to be a current liability, as you will tend to pay them on an ongoing basis, and it's usually quite soon after you receive the supplies. So those are our types of liabilities. We've got long-term liabilities, which we call non-current liabilities, and short-term liabilities, which we call current liabilities. And hopefully this definition of liabilities makes a bit of sense, and just the key term here being owe. It's something that you owe, and on the flip side, in the previous video, assets were something that you own, so that is our distinction there. So that will wrap up this video. Hopefully it was useful. If it was, please do drop a like rating. Make sure to check out the playlist to check out more accounting videos, and subscribe to add some econ to your subscription feed.